How does a company maximize the return on investment of implementing work comp management best practices? Hello, my name is Michael Stack, and I'm the CEO of Amax. And the short answer to that question is how does a company maximize their ROI? Is to start with the right insurance structure, whether that be a guaranteed cost or a retro or a captive or high deductible program or self-insurance policy. But the question is, how does a company then determine what is the right insurance structure for them? So often I see this done in the marketplace so incorrectly. And only a small percentage of the time is this actually done right. Most of the time it's just sort of done willy-nilly. And you're just kind of guessing. Or the insurance broker says, hey, I've got this really awesome retro policy, retro plan with this XYZ carrier, and I think you're perfect for that. Or hey, I've got this really awesome captive because I know captives really well, and I specialize in captives, and I think everyone should be in a captive, and you should be in a captive too. In short, what often happens is that if an insurance broker is a hammer, everyone looks like a nail. And if that hammer is a captive program, or if that hammer is a high deductible program, or if that hammer is a retro program, or even if that hammer is a guaranteed cost program, I mean, all you know is guaranteed cost, every single company you look at looks like they should fit into that program, which is not the right way to do it at all. You need to raise yourself up and have a higher level of professionalism in the marketplace to analyze an employer's needs, or if you're an employer yourself, to analyze your own needs and be able to ask the right questions to your insurance broker and risk advisor team. So, what I want to talk about today is these 4 cornerstones of risk financing, what they look like, and how you start to go about making this decision. Because when we're talking about maximizing the return on investment, why are we implementing particularly from a senior management standpoint, why are we doing all this work with return to work? Why are we working on our injury response systems? Why are we working on building out our medical networks and building this adjuster team and building out this really partnership with all our whole risk financing or risk management team? Why are we doing all that stuff? Of course, it's to impact those injured workers, but particularly from a senior manager standpoint, it's all about that bottom line, and that's what's going to fuel. If you hit that bottom line right, then you'll really be able to fuel that injured worker being able to really take care of them as well. All right, so let's talk about these 4 cornerstones and what they are. And again, this is how you're going to go about really starting to make and analyze this decision. I'm going to write these out here first. These 4 cornerstones are your risk tolerance, how well you're doing with implementing work comp management best practices. That's all the stuff we were just kind of talking about there. The predictability of your risk, how well you can analyze these large numbers and predict the losses for the future, and then the financial impact. So these are the 4 cornerstones. And I'm just going to kind of run through these again very quickly because this is all about changing the mindset. And if you can get out of this video to change your mindset of how you examine this, from being a specialist in retro programs where everyone looks like they fit into a retro program to now being a professional in the marketplace, to now determine via these 4 cornerstones and asking these questions and having this perspective and how you look at this to change up that how that looks like for you. Okay, so risk tolerance, how comfortable is an organization with this variability of risk? Are they really risk averse and they want to be very conservative? They want to be very predictable. We're going to write a guaranteed cost check, and we're going to know that in our budget, and that's going to be solid, and we can predict that out, and we're in great shape. Or can they handle a little bit more variability as far as what's going to happen with their losses? That's sort of question number one. What helps you then be more comfortable taking on more risk is these 2 things right here. These 2 things are going to help you be more comfortable in taking on more risk. One is if you know, whoops, I wrote best twice there. If you know you're doing really well in your return to work program, you know you're doing really well in your injury prevention program, you've really cranked that up, you've dialed everybody in, you've gone through the supervisor training, your supervisors know how to respond to injuries appropriately, you've built out your claims handling team with your adjusters, and you're just cooking with gas, you can take on a lot more risk because you know that you've reduced it on your own side. Same thing with this predictability of risk number. This is a big, big factor in this decision-making process. If you're going retro or high deductible or captive or self-insured, you start to look at this law of large numbers to say, well, how likely are we to now incur these losses? How likely, based on actuarial data, big numbers, based on this predictability of losses, how comfortable are we? And in this section, you're going to get some help. You're going to get some help from an actuary, most likely, to help you have this predictability of risk. And the more comfortable you are with that, the more risk you can take on. So big two pieces here. And then, of course, the financial impact is understanding that financial impact, both tax implications from your different structures, and then that risk reward feature as well. As the more risk that you take on, obviously the more reward an organization is going to take. This is a very complex topic as you start to unfold it and as you start to dig deeper into this. But again, the point of this video today is to change your perspective on how you look at this, to raise up your level of professionalism to say that this decision isn't about the market. This decision is about what's best for the client. And if you are the client, if you are the employer client, to now have these four things: your risk tolerance, how well you're doing at managing work comp, the predictability of risk, and then the financial impact on your organization. Those are the four cornerstones of now how you start to go about making this right decision to maximize that return on investment. Again, my name is Michael Stack. I'm the CEO of AMAX. And remember, your work today in workers' compensation can have a dramatic impact, as we've talked about here, on your company's bottom line. But it will have a dramatic impact on someone's life. So be great.